Hey there! Maybe you've heard about stocks, the stock exchange, or shares. What are they, and how do they work? Stock represents ownership in a company. When you buy a stock, you own a tiny part of that company. So, imagine if you own 50% of YouTube stock, you own half of YouTube. Share is a single unit of ownership in a company. For instance, if all YouTube stocks consist of 10 shares and you own 5 of them, you possess 50% or half of YouTube. A stock exchange is where you can buy and sell stocks, such as the New York Stock Exchange, NYSE, or the NASDAQ. So why do companies issue stocks? Companies issue stocks to raise money for various purposes, like expanding their business or funding new projects. When you buy a share, you become a shareholder and get a share of what the company owns and earns. But how does stock really work? Let's break it down with an example. Meet Sarah. She's passionate about pizza and has a dream of starting her own pizza restaurant called Sarah's Pizzeria. After calculating, she realizes she needs $100,000 to start her restaurant, but she only has $50,000. Sarah has multiple options for funding her venture, like taking a loan from the bank or finding investors. She decides to find investors who want to support her business, so she sells ownership in her pizza restaurant. She divides the ownership into 10 small pieces called shares and sells them to interested investors. Since the total cost is $100,000 and she already has $50,000, which represents 5 shares or half of the total ownership, Sarah sells the remaining half ownership in 5 shares, making each share worth $10,000. Now, meet Alex. He's a pizza enthusiast who hears about Sarah's plan to start her own pizzeria. Excited about the idea, Alex decides to buy 1 share for $10,000 of Sarah's pizzeria. By purchasing 1 share, Alex becomes a shareholder of Sarah's Pizzeria, owning 10% of the business and entitled to a share of its profits. With successful sales to 4 more investors, Sarah secures the $100,000 needed to start her pizza restaurant. 5 years later, Sarah's Pizzeria prospers, opening 3 more branches and increasing in value to $300,000. Alex, who owns 10% of the restaurant, sees his investment value increase from $10,000 to $30,000. If Alex decides to sell his 10% share, he would make a $20,000 profit. However, if Sarah's Pizzeria fails to compete or experiences lower sales, the restaurant's value could drop from $100,000 to $80,000. In this case, Alex's investment value would also decrease from $10,000 to $8,000, meaning he lost $2,000. Sarah's Pizzeria may eventually expand to become a national or international pizza chain like Domino's Pizza or Pizza Hut. As the restaurant's value rises, Sarah may choose to list it on a stock exchange like the New York Stock Exchange or NASDAQ, allowing the public to buy and sell its stocks. So, why people invest in stock? Because they hope the company will do well, making their shares worth more. They can sell these shares later at a higher price to make money. Sometimes companies also give out part of their profits to shareholders. This is called a dividend. But there's a catch. The stock market can go up and down, and sometimes companies don't do as well as expected. That means the value of the stocks can drop, and you could lose money. It's a bit like a roller coaster ride. So, if you're interested in buying stocks, it's important to learn as much as you can. Maybe start by buying shares in companies you know and like. Also, don't put all your money into one stock. Spread it out in some different stocks. You can buy the stocks for trading or investing, and I will explain both in next video. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.